0.14%. That is the entire trailing dividend yield on AEM Holdings right now on a stock riding one of the strongest AI hardware stories on the whole exchange. That contrast, fortress balance sheet on one side, near zero income on the other, is exactly the split decision my forensic framework was built to make cleanly, and conflating the two is how retail investors get trapped. Does the strongest AI hardware story on the exchange change the verdict for retirement money? AEM Holdings sits right at the center of the AI capex cycle, but an AI narrative is not a dividend check. There is the investor still years from drawing down capital who can treat this as a growth position, and there is the retiree who needs portfolio income today. Both deserve the exact same data, but they will use it very differently. Let's look directly at the math that creates this tension. $100,000 invested in AEM Holdings pays you exactly $140 per year in dividends. That is less than a single month of NTUC groceries. The trailing yield sits at 0.14%. You have a massive semiconductor player benefiting from AI momentum, but for an income investor, that yield is effectively zero. Before we run through the numbers, one thing needs to be said plainly. AEM's Zone 5 red zone verdict is purely a yield structure verdict. It is not a statement about the business falling apart or going out of business. That distinction matters immensely. So let's get into why. Starting with the positives, the balance sheet is genuinely close to bulletproof. AEM sits on a net cash position with cash and equivalents of $77.3 million against total debt of $16.4 million as at FY 2025. Debt to equity is roughly 0.03 times, effectively debt-free. Interest cover sits at 14.6 times, far above my 4 times floor, and net debt to EBITDA is negative. There is no debt wall, no refinancing cliff, and zero solvency risk flagged. Second, the revenue growth is real and accelerating, not just market hype. For Q1 2026, revenue climbed 35.8% year-on-year to $116.86 million, with net income turning around sharply to $14.34 million. Full year 2026 revenue guidance has been raised to between $550 million and $600 million, backed by a key partnership with AC to target hyperscaler customers. Third, institutional capital has been moving in. Sourced directly to Longbridge reporting, AEM led the Singapore tech sector re-rating with approximately $183 million in net institutional inflows by mid-2026. Big money that performs rigorous due diligence has been actively buying this name, not just retail traders chasing AI headlines. Now for the negative case, and it starts with a decisive failure. The FY 2025 dividend resumed at 1.3 cents per share after 2 full years of paying zero, giving a trailing yield of 0.14%. My minimum yield hurdle sits at 4.7%, which is more than 30 times higher than what AEM actually pays. Even my conservative baseline forensic floor of 3.2% is nowhere in sight. Let's put this in kopi money terms. A $100,000 allocation to CPF special account earns $4,000 a year in guaranteed interest at 4%. The same $100,000 in AEM pays you $140 a year, which is less than the cost of a single family dinner out. That massive gap is not a rounding difference, it is a structural divide. This brings us to who this actually impacts in the heartland. If you are an accumulator years from drawdown, near zero yield is irrelevant because you are playing for price appreciation. But if you are a retiree in Marine Parade relying on monthly dividend income to pay bills, AEM simply cannot do that job for you. Conflating a satellite growth trade with a core income holding is a critical mistake. The second drawback is valuation. At $9.03, AEM trades roughly 33% above Investing Pro's fair value estimate of $6.03. Paying a premium for growth is defensible, but doing so with zero yield cushion leaves you zero margin for error if AI capex sentiment cools or a single quarter disappoints. Third, there is legal overhang and an incomplete recovery. On July 20th, 2026, Advantes filed an amended US patent infringement complaint against AEM. While management expects no material impact, litigation brings headline risk and ongoing legal expenses. And here's the thing, FY 2025 net income of $17 million remains far below the prior cycle peak of $92 million to $127 million. Management's raised FY 2026 revenue guidance of $550 million to $600 million shows they believe the recovery has room to run. However, a stock already trading 33% above its fair value estimate has already priced in a lot of good news. If the AI cycle slows down, there is very little yield or valuation buffer to cushion the blow. Strip away the AI narrative and ask the primary question, does this stock's income profile do a job a retirement portfolio needs done? The answer is no, not even close. AEM is plowing cash back into business expansion, answering a growth question rather than an income question. To break down the bottom line, accumulators with a long time horizon may find AEM's fortress balance sheet and revenue trajectory worth researching as a satellite growth position. For retirees relying on CPF, SRS, or dividend distributions for monthly living expenses, this stock cannot fulfill that role today. Looking at our checklist, trailing dividend yield sits at 0.14% against our 4.7% hurdle, marking a hard gate fail. Interest coverage is strong at 14.6 times against our 4 times floor. Net debt to EBITDA is negative, and debt to equity is 0.03 times, passing easily. Weighted soft flags stand at 0.5 for trading above fair value. Every balance sheet metric passes cleanly, but a single yield failure triggers the red zone. Examining the trajectory, AEM paid 0 dividends in FY 2023 and FY 2024. The FY 2025 resumption of 1.3 cents is roughly 13% of the prior cycle peak of 10.3 cents. 2 years of 0, followed by a small resumption, signals that management prioritizes capital expenditure and research over shareholder distributions. In this market, the difference between a sanctuary and a yield trap is decided in a single trading session. While free subscribers are reading yesterday's story, IGGY'S elite investors are already cross-checking the next setup together in real time. Before we move to the final metrics, if you want 0-day breakdowns before the market opens, the complete Red Zone watchlist registry, and institutional cheat sheets built on this 5-layer audit, IGGY'S elite investors gets you there. For $9 a month, less than Kopi and Kaya toast at Raffles Place, you stop being the exit liquidity and start being the analyst. On valuation sources, Investing Pro sets fair value at $6.03 within a $4.81 to $10.25 range, putting the current price at a 33% premium. Conversely, Longbridge analyst William Teeing maintains a buy call with a $10.15 price target, citing the ASE partnership. We report these figures as attributed facts without taking a directional stance. Here's the thing about a stock like this. The AI capex story and the yield failure are not in tension with each other. They are the same decision playing out twice. AEM is choosing to plow capital into capacity and R&D rather than dividends, which is exactly the right call for a company riding a genuine demand surge. It is also exactly why this stock cannot do the job a retirement income portfolio needs done. A fortress balance sheet tells you the company won't fall over. It tells you nothing about whether it will pay you anything while you wait. Those are two different questions. Compare AEM's Zone 5 to Cetrium's Zone 5 in this same registry and you'll see why red zone doesn't mean one thing. Cetrium fails on yield, weak interest coverage, and thin cash conversion all at once. A genuinely stressed balance sheet wearing a low yield on top. AEM fails on yield alone, sitting on a net cash position with interest cover more than 3 times my floor. Same zone label, completely different underlying story. If you're only reading the zone number and not the reason behind it, you're missing the one distinction that actually matters here. AEM lands in Zone 5, red zone, net cash, strong interest coverage, and 0 gearing concerns give it a fortress capital position. However, the 0.14% trailing yield falls far short of both the 3.2% forensic floor and the 4.7% minimum yield hurdle, making the red zone classification absolute. Long-term growth investors, real revenue acceleration, a fortress balance sheet, and institutional buying make a compelling growth case on its own separate merits. I am Iggy, forensic investor ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, IGGY'S elite investors get 0-day access, link in the description. We will review this name next earnings cycle, or sooner if a dividend increase closes the gap to our floor. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MES licensed financial advisor before committing funds.